Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
Hey, Brian, just you and me today. Let's do this. We are talking how can people get into a home in 2026. We're going to talk about the top 5 things that we know are plaguing people, that they're behind on the other side of the screen. They're asking themselves, what do I got to do in order to get a house in 2026? So we're going to talk about that all today. How's that sound?
That sounds perfect.
The first thing right out the gate is helping people, qualify like now versus someday credit. What is going on with people's credit right now? What do they need to do in order to make themselves credit worthy to get underwritten and approved in financing land in your neck of the woods?
Yeah, so I think that the first step is really just understanding your credit profile and what certain accounts, what certain things do, and how those play a factor into your credit. So I would start by getting more educated, and you can download your Experian app. You could use a Credit Karma if you aren't actively looking at your credit. But now let's say you over the past few months you've racked up a little bit of debt and you've been leaning on your credit cards a little bit more, so your credit scores has dipped. What I would do is create a plan where you're able to pay off the highest interest cards at the beginning so that you could start bringing those balances down. And as you're bringing those balances down, your credit score is going to be going up. So I think it's very important to understand that when it comes to credit, it's not just your score that the banks are looking at. They're looking at your credit history. They're looking at your on-time payments. Or you're looking at your credit utilization. So you have to understand how all those things play a part and how you can minimize the credit utilization so that you can increase your scores. And all that is done by going over your report, seeing what the true realities are, and then actually coming up with a plan. Nowadays, it's so easy if you don't want to, go to a credit repair specialist. If you don't want to be vulnerable and ask for help to somebody that, that may be able to guide you. Use your report, slap it onto your favorite AI source, and have it read to you what it is that's bringing your credit score down, what it is that you can do to, take action steps to increase your credit, minimize your debt utilization and balances by letting it know what your habits are, your spending, your income, your debts, what you pay every month, and what your life consists of, so that the AI can thoroughly come up with a plan that's going to be geared around your information and your only.
I want to talk very specifically about what's hurting people most in credit land. Is it that the score is low only, or is it that there's late payments and then that's why the score is low? Is it because the balance compared to the limit is high? What's actually happening when you're looking at people's credit that you're seeing that they have to go and attack?
So it's case by case, but the two common ones that I see a lot is high credit utilization. So what that happens is that obviously your credit scores go down. So when your credit scores go down, that's going to play a big factor in your interest rate and how you get the lowest of the lowest and the best pricing. Now on the other hand, it's those missed payments, and those are actually more important than anything because that's showing the banks and showing creditors your responsibility and how you're paying back those credits, those debts that you acquired. So when a bank looks at you and they say, you can't pay your small credit card, or you can't pay this car payment, or hey, that loan that you took out, you aren't able to make those payments. What's to say that they're not going to be like, hey, well, if you can't make those payments, how are you going to make this big payment? And that's a huge factor when banks are looking at your credit and not just your credit score. Your credit score is just a representation of what your credit history and your credit profile is, but your credit history and your payments is really what's going to determine and what really holds up, people in getting approved or not.
You had mentioned also, paying down the debt that's connected to the highest interest-bearing credit card first. Depending on how much the balance is, it's not always the highest monthly payment, but it's the one that's costing you the most in carried interest debt servicing in that sense. So I want you to give some practical terms. So what is the difference between talk to me dollars and cents when someone is doing a credit card pay down and they're having $200, $300, $400 a month, should they expect that much buying power on the mortgage side, or is it a ratio where they can actually get more on the lending side when they clear up that monthly payment of $200, $300, or $400?
Yeah, so it's more along the lines of it's going to lower your debt to income ratio, which then allows you to be able to afford more. So I I'm not exactly 100% sure, but let's just go ahead and use like 250 will get you anywhere between maybe like 20 to 25K more in approval. So just based off of that, right now I have clients, and you brought up a good point. The highest interest isn't always the highest balance or the biggest monthly payment a month. So what I would suggest, and I will digress back from what I said, is try to pay off the balances that are the highest in monthly payments. So what I mean by that is that sometimes I see that there's credit cards that could be like, for example, $3,000 in balance that you owe, but their payment is only, let's say, $85. But then they have another personal loan for, let's say, only $1,000 that they're making a $400 payment on. I would suggest knock that one off first, because then you're going to get $400 back into your debt to income ratio, opposed to paying $3,000 and getting $85 back. That's going to make a bigger difference in how much you get approved, how much more you get approved for, because you're paying a higher monthly balance than a lower.
So let's talk in numbers. So let's say someone's approved for $500,000 and they need to get to $550 or $600. How much buying power is freed up when, let's say, you pay off $500 a month? I know I'm asking you just like live math, but like, let's say someone frees up $500 a month that they're currently using for credit card payments. How much do you think? I know the interest rate's a factor.
Yeah,
I understand that. But let's say someone wants to go from $500,000 to $550. If you pay off $500 of credit card debt, is that enough to have paid off to open up enough buying power to go from $500 to $550? Is that an equivalent ratio? Like $500 equals $500 of credit card debt equals $50,000 of potential buying power increase over here?
So I don't know the math right off the bat, but yes, that's essentially how it works. I would say that for every $500 that you pay off, you're probably going to get back anywhere between $30,000 to $50,000 back into your approval power. So if you're saying, hey, by $1,000 you're wiping off debt, yeah, you might be approved for anywhere between maybe like $100,000 to $80,000 more. So yes, just for example purposes, if you were to wipe off $500 from your current reoccurring monthly debts, that could potentially turn into $30,000 to $50,000 more of buying power.
Now, when people take action on their credit and they make these changes, they pay down their balances, they're working on it. I know the late payments is one thing. That's going to take time to like get further and further in the rearview mirror. But when it comes to the credit utilization and how much balance there is relative to the limit, how much time should someone realistically expect once they've paid that card off for that to positively start helping their score? Is it right after the next payment cycle? Is it after like 2 or 3? What's been your experience?
So it depends. If you're in the pre-approval process and you say, let's say you just paid off all your debt, at the time that I run your credit, it's probably not going to reflect. But what I can do, what lenders and brokers can do, is they can omit those debts or already mark them as paid off. So they can already take that into consideration for your debt to income ratio. What won't happen is your credit scores won't increase, and obviously they won't reflect. But down the line, let's say you get into contract a week or 2 weeks after that, we can do what's called a rapid rescore, and at that moment you can prove to the bank or to the credit bureaus that you've paid down that debt by getting your payoff statement letter and showing, hey, this is paid off. We will take that, we'll run a rapid rescore, they'll update your balance, and then in that moment, 2 to 3, maybe a week's tops, you'll have your updated credit scores, updated credit balances, and all that good stuff.
So I want to immediately go into the next thing, which is buying house with limited cash. Mm-hmm. And the reason I'm jumping right to that is because once you kind of have that credit issue solved, it should be freeing up cash flow in your monthly budget that you can start saving some money. And I want to kind of contend against the 20% down, 10% down. Sometimes you can still get in with 0% down in the VA world, 3% down conventional with some exceptions, 3.5% FHA. So I kind of want to circle around those. The VA, no money down, conventional with 3 to 5, and then FHA 3.5%. So there are still ways to get into a home in 2026 with limited money down. Now, again, on a $500,000 example, I know some of you were watching this in San Diego. You're like, where's that? You know what? You let us know where those are at too. But you're talking maybe $15,000 to maybe $30,000. Let's just keep it easy math. You need to save $15,000 to $30,000 in the next 6 months, 12 months in order to have that much money. That's still realistic. It's possible. You might need to do some things like paying off debt. You might need to sell a couple things that are holding you down. Maybe there's some asset you have that you could convert into cash, or maybe there's some way for you to pick up some extra hours or extra work here or there to accumulate that extra money. That being said, let's talk about the best case scenario for all three. So let's talk about VA first. What's the best case scenario for someone who's active duty military or veteran that wants to do a 0% down purchase here in San Diego?
Yeah. So, right off the bat, a lot of people, and, it's a misconception that, no money down means no money out of pocket. The most ideal situation for a veteran buyer is to be able to buy their house, no down payment, but also get their closing costs covered by a seller credit. So that's one of the ways that they're able to come in with minimal to no cash out of pocket. And, with the VA being, as relevant here in San Diego as any other loan, it's a lot easier for a veteran to come in with a lower earnest money deposit, which could be, less than the 1% that is typically what a lot of people put in. So with the VA, you're a lot more accessible to coming in with less money and having to come out, with less money out of pocket for closing costs. Now, on the flip side, for conventional and for FHA, we'll go with conventional first. Conventional is going to be a little bit more expensive as far as loan costs and loan fees, and it's also going to carry a little bit of a higher rate because it's not backed by any government backing. So what that happens is that they do allow for a 3% to 5%, but it all comes down to your income limits. So depending on what your income is for conventional, you can come in with 3% if you're under the, I believe is 80% median income for whatever area you're at. So if you're within that range, you could come in with 3% on a conventional purchase, and rates are actually going to be a little bit below market value. If not, you can come in with your regular 5% down. You're going to have a mortgage insurance, and you can still get your credits negotiated by the seller. So that's an advantage that all loans have. They could get seller concessions to cover your closing costs, but the down payment is going to be the biggest source of money that you have to come up with as a borrower.
Yeah.
Now on the FHA side, 3.5% down, and like you said, it could be anywhere from $14,000 to $30,000 depending on the purchase price. But these are realistic, attainable, quantities of money that people could save up or hedge with their tax returns at the beginning of the year. And I think that's a play that a lot of people should look into, because if you're expecting some sort of tax return and it's anywhere between that realm, you already have, a good chunk of that money going towards you. So I would say that if those are the choices or the options that you fall yourself into, you don't need to save a 20%. You don't need to have a 10%. You just have to have a smart plan to have the money, or combine with either, maybe some of my clients are pulling for the 401k. Some clients are getting gifts. Some clients are selling things that they don't need anymore. So there's different ways to skin the cat. And that's another way that I wanted to tell clients. You could get gifts from parents, friends, or family members. You can sell stuff that you don't need anymore. Things like that could help you get more money. But there's also another one, which is the down payment assistance. And I'm actually in the process of doing one right now. You'll hear this all throughout, social media, through the news outlets, CalHAFA, the 20% down here in California. But one thing you have to be very cautious about these programs is just because they're giving you the down payment doesn't mean it's going to be the cheapest. It doesn't mean that it's going to be the best deal. Nothing is free. So there's certain programs that allow you to get that down payment as a gift, but you either have to pay it back on a lump sum, you either have to pay it back on a monthly basis, which then adds another monthly fee to your monthly payment, or you just have to share appreciation with either the state or the bank once you refinance or you get to your maturity period. Yeah.
There's a lot of really good information there, Brian. And the reason I'm glad you just rattled all that off. I was I think I'm gonna have to ask him about some of these things, but you went for it, which is super dope. But I was over here thinking gift funds. That gift funds is one of the main ways right now people are, I don't have $15,000. That's fine. A lot of people don't have $15,000. But the person who loves you, who wants to see you as a homeowner, who does have $15,000, can give you $15,000 as gift funds, and you're able to apply that towards a down payment, of course, down payment and closing costs, whatever that might look like, and the down payment assistance program.
Yeah.
Yes, it may look unsexy to be I got to share this equity on the back end, or I got to participate with the local agency on this or that. Well, if that's your way in, that's kind of the way in. And it's not meaning we're going to corner you into a market and back you in a bad situation. I will say this very clearly as I can. If you accept the program like that and you cannot make the payment, then you shouldn't be making the house purchase anyways. Yeah. Let's just be real. If you are shoehorning yourself into it, don't do it. the down payment assistance program is so that it gives you that breathing room, that the budget you have and what you can qualify for, you can still live a quality life with. It is not to put you up against the wall and put pressure on you financially.
Yeah, and I think if you're at that point, you should really, take a step back, because I'll take that back. I think a lot of people right now are scared because of the payments. And that's one of the reasons that I feel a lot of people are still, 1 foot in, 1 foot out. But what I will say is that a lot of the clients that have bought maybe about a year or 2 years ago where they had higher rates, they're now looking to either make their second move, sell their house, or do something with their property. And they still made every payment. They were very, very cautious, very emotional in the stages when we were closing, which is very understandable. You're making a big decision. It won't feel real until you actually pull through with it. But what I'm trying to get at is that it's okay to experience that fear. But if you're uncomfortable with the payment because you can't make it, because you can't afford it, and you're just trying to make it happen, you shouldn't be buying.
Yeah.
But if you're in the position where you're like, I want to buy, the payment is a little bit higher, I can't afford it, but I don't want to, you should reevaluate that thought, because buying the house isn't hindering you in any way. It's literally like a setback to set you up for what's come later on down the line. And by having that, you're hedging in. You're putting down you're putting your place in the monthly payment where it's not going to move. You know what you're going to be paying, and from there you can start adjusting your life, because now you're not living by reaction. It's solidified.
That's awesome, man. I want to go next right to negotiations. Mm-hmm. Now I know that that's like not a pre-game thing you can do to get yourself ready to buy a house, but I think well, let me adjust my statement. I think there's some things you can do that are conditional based on the situation you find yourself in.
Correct.
So, we're talking about credit, we're talking about down payment. Those are things you have to do before you're ready and qualified to go get a house. But I'm also going to contend that having a negotiation strategy is part of that too. Know what you need as part of your plan to go house shopping and making offers and having recommendations for how to negotiate.
Yeah.
Recommendations for concessions. So beyond the black and white part of it, what are some of the things that black and white meaning like, oh, I know I'm going to need $5,000 towards closing costs. Okay, well, that's very black and white.
Yeah.
Well, how are you going to go about getting that? Like how are you helping people navigate what they should and shouldn't be doing when it comes to negotiations in 2026?
That's a good question. So one of the things we're seeing right now in at least the last few transactions, right off the bat, when we submit offers, the agent's already communicating to the listing side and the selling side that our buyers are going to need closing costs. And I think right now with the climate of the market that we're in, a lot of people understand that they're going to they're going to have to give some sort of concessions or some sort of leeway to make the deal kind of get a little bit better. And we're very upfront. The client wants the closing costs because they don't want to come in with any other money, because A, if there's repairs that they need to make, they want to use some of that money. But B, they also want to bring down the rate, because obviously we know the payments are a little bit of a factor right now. So that's a strategy that we go in with, and we let them know, like, hey, right off the bat, we ask for the most. I always advise the agents, the clients, ask for the most, because then they can come down and let us know what they're willing to give us, and that's fine. But if you ask for less, then they go less, now you kind of shot yourself in the foot. So ask for the most within the means of it being reasonable. But a lot of the things that they're asking for is simple cosmetic like repairs that the seller's not going to want to do, because A, that incurs time for the deal to get extended, and they don't want to waste any other money, because if something else comes up, that's more money that they have to come out of pocket. So they'll say, hey, we'll put a pin on it, we'll give you the money, you guys could take care of that outside of escrow, and it is what it is. So I think that's the biggest thing right now, just being upfront and honest with the credits and asking what the seller's looking for and if they're willing to entertain that, because I think that's the most practical way of going about it is straightforward communication. Mm-hmm. Asking, are they willing to give this much in credits?
Yeah, and I guess this is the part I wanted to bring up was that if you pre-think your negotiation strategy, then you can find sellers who they are looking to get out of the situation they're in that meets the litmus test on your side.
Correct.
So if there's someone who has either a time-sensitive sale or they're in a financial crunch themselves and like, hey, I just got to sell the house. Yeah, I might take a $20,000 haircut in concessions because I need the other $100,000 that's left there for me. But if I try to get it all, it's going to stay on the market longer. That knowing that that's what you need might meet them right in the middle, or maybe even a little bit more on their side or yours, in order to get what you need in the deal to close successfully.
Yeah, and I think that's the mindset that buyers should go into it with, like asking their realtor that's leading them, like, we need to identify what the seller's motivation is. Do they need to sell quick? Do they need it because they're, they need money? Because then that allows us to understand how we can go in with the negotiations. Quick close and ask for credits, or long close and still ask for credits, or quick close and ask for minimal credits. And you guys put half and half, because also what you don't want to do is just shoot blind. And then, now you don't know why your offer didn't get accepted. You didn't get a call back. So I think the buyers need to make it very, very, and I think that, the realtor should know this as well already, but the buyer should be prepared to let them know, like, hey, we want to know this, and that, because that's going to let us know whether we should ask for credits or not. I think as a buyer, you have the power to ask for anything that you want, whether you get it or not. It's all negotiable, but you can ask. And I encourage buyers to ask for everything and anything that they want, because the seller could just say no or say yes, or say not like this, like that. Or
the seller can say no, or they may even come up with another creative strategy that you're not even thinking of. The listing agent might be like, hey, we can't do that way, but we can do it this way.
Exactly.
So don't just, I guess I'm saying, don't filter yourself out and prevent yourself from asking because you just think they're going to. Don't prescribe their answer for them. Let them give you an answer. And then maybe they even will surprise you and have a solution. It was actually one of the questions I was going to ask you is like, hey, what would you tell people who think they have no leverage? And it was going to be like, ask anyway. So I mean, I'm already answering the question, but like that's what I would tell someone who thinks they have no leverage. Ask anyway. They could say no and give you no information, or they could say, yeah, maybe let's figure something out, and then you're working out a deal.
And that's exactly how deals are happening right now. All the deals that we've got in escrow is because the agent, the buyer's agent, the seller's agent, and myself have been in constant communication of like, okay, how can we make this deal happen? Listing agent, what does your sellers require? Well, we want 30 days and 30 days back in rent back. Guys, what do we need? Well, we need full closing costs, or else we're not. Okay, cool. Where do we meet in the middle? So things like that, when you're kind of going back and forth and, asking with confidence, but at the same time, not just taking anything that they give you, you could push back. You could do a buyer's counter offer if you don't like the terms that the seller comes back with. It's okay. Don't be afraid to ask for what you want right now, because it's time to ask. It's time to say, hey, if this is what I want, what are we willing to do and how do we get it? Don't be afraid.
That's awesome.
Yeah.
So let's talk about loan programs. I want to talk about 2-1 buy down still a thing. We got ARMs, which people are old school afraid of, but new school having to rethink. And maybe that's my temporary solution for a long-term play in buying and owning and holding. And then just a straight up 30-year fix. So I want to talk about each of those kind of, as succinctly as you can, but also as clear as you can. Let's talk about the 2-1 buy down first. Then let's talk about ARMs, and then let's talk about 30-year fix.
Cool. So with the 2-1 buy down, it's still very relevant because of the the higher price points and the rates still kind of being in a little bit of a higher environment that we want. But what I will say is that if you're able to get it, great. But a lot of people utilize it to same thing, hedge against the high rates. 2 years they'll get a lower payment. That second year, one rate lower than what the the main one's supposed to be. So they're still out there, just not as popular and not being asked up front as they were about a year and a half ago. But they're still there now. A lot more of the credits are geared more towards covering all closing costs, whereas before it was like, hey, we'll cover closing costs, but we need that 2-1 buy down because the rate's a 7.5. So now it's not as common, but there's still some people that ask for it in the higher price point, like above 800,000. People start asking because the payments is kicking six plus. So
$6,000 a month plus. Yes. Say the whole thing, man. Say the whole thing. So, $6,000.
So just so you have an idea, so we're doing an $875K purchase, VA loan, no mortgage insurance, no down payment. Rate was around 6%. Their payment was $6,200. So
active duty or veteran?
Veteran.
Okay.
Veteran.
Wow.
No funding fee. $6,200 a month.
Wow. We're there. That's where we're at now. That's where it's at, guys. Okay, so you talked about the 2-1 buy down. Talk to you about ARMs really quick.
Yeah.
Where does it? Oh yeah, your sleeves all rolled up. You unroll that. Oh, you got a bruise right there.
Oh wow, man.
Dude, your arm is all messed up. You got two. Hey, if there's any sign that you have two boys, there's right there. Two sons.
Yeah, that's from him sleeping on my arm.
Let's talk about ARMs. Yeah. What's the good? Or how am I trying to say this? I'm trying to say, what is the use case for an ARM in this environment?
Yeah, honestly, I've been having this conversation, and the way you have to look at it, if you've been following the market, we know that rates are already on the down. And as we progress, rates are going to continue to go lower, lower, and lower. We've seen the Fed dot chart. We already seen the trajectory of where things are heading. Maybe it's just at a stall right now, but things are generally heading towards, rates are dropping. So if you know that with the ARM, it's fixed for a period of time that you choose. It could be 3, 5, 7, or whatever term you choose. A 501R means that for 5 years it'll be fixed, and when that 5 year comes, it's going to adjust one time every so often period, whatever your program is. But right now, let's say that you want to get into a house. The rate might be a little bit higher, the payment's a little elevated. But did you know that ARM rates are actually about 0.5% to maybe 1% lower than what regular 30-year fixed rates are? So if we know that as well, then we know that if we get into a ARM right now, it's going to be fixed for whatever period of time you chose, 3, 5, 7, 10 years. And after that, it'll adjust. So if rates continue to go down, by the time your period of adjustment comes, or you decide to refinance, because you could refinance at any moment within 6 months to 8 months in your first 6 payments, you can take that lower rate without any prepayment penalty. So it's a strategy right now to hedge against higher rates. And if you're able to lock it in and understand that if you refinance or you act before that adjustment period, your rate's not changing, or it's not going to something that you don't know. But also keep in mind that the rates by the time that they go to that period should be a lot lower than what they are today. So if you're willing to understand how an ARM works, you could save a lot of money in these few years until rates stabilize and go down.
So it sounds like, and I don't want to put words in your mouth, but it sounds like you're saying use it more as a strategy than your only way in the door. Because it's like, if that's the only way in the door, that might be that shoehorning thing I'm talking about, where you're just like squeezing yourself into the deal. Again, maybe you choose to do that, maybe you don't. I don't think that's the best case scenario for yourself. But look, if you're trying to be a homeowner and that's what it takes, okay, fine, I get it. But you're saying more tactically speaking, look, in the environment where rates are expected to go down and then stay down over a longer course of time, maybe the 3 year or the 5 year is a good choice because it gets you into the home at a more affordable payment that you could still pay a regular 30 year for, but then maybe you could do something else with that gap money, that extra margin. It can go into something else. Or in some cases, maybe you got to touch up the house a little bit. Maybe you want to buy some new furniture. You don't want to don't finance your furniture. So please don't finance a car before you buy. I'm totally going off topic.
So I'll give you an example. So for somebody, let's say that just entered their career job, and they know that in maybe 3-4 years they're going to get a job raise, and they're going to their income's going to grow. So if you know that right now, you could get in at a lower payment, hedge against the higher rates, have a lower payment for whatever period it is, and then there's no prepayment penalty. So if rates get better that following year or in 2 years, and you say, hey, I want to refinance, you can get out of that rate, lock in for 30 years, and now you don't have to worry about your rate adjusting. So it's the way that you utilize and the way that you look at it. But I think it's a strategy for you to be able to get in if you don't want to have a higher rate right now, and you understand that if you refinance or get out of that a product before it adjusts, your rate's not going to change. Then I think you should move forward with it. But if you're still on the mindset like, oh, I don't know, I'm scared about it, then you probably shouldn't even touch it and just stick with the 30-year fixed finance. But those that are savvy, that probably invest and they understand the power of leverage, this is something that you probably should look at alongside your 30-year fix, just to compare side to side to see if it might make more sense for you.
So talk about the 30-year fixed use case. Who is it? Like, what profile of person are you suggesting just skip all the other options and go right to the 30-year fix? Who is that you're telling that to, and why are you telling them that?
So it'd probably be for like salary workers that have fixed income, somebody that knows that, hey, this is what I'm making. I'm probably not going to get a job increase. I could probably afford this for, a good period of time, 5-10 years. That's people that should lock in for 30 years. I won't say what type of jobs, because I don't know, incomes go from all over the place. But
so you're talking more like a type of pay, like salary pay, and maybe there is the prospect of promotion, but at your current level of employment, you're going to be able to make that payment that's fixed every single month, every single year.
You also got to think about it. If you've been having the same income and same pay for 5 years, unless you know that there's going to be an increase, then, you can't be too aggressive with, using a program like that, because you don't know what the market's going to do, or you just, you want to make sure that you can afford what you can afford. So people that have, fixed income that might not be having a job, a pay increase, or don't get bonuses, and just need to find something that they could be comfortable with, have the same payment, don't have to worry about rent going up every month, or move place to place because rent's, fluctuating. I think those types of people should look at a 30-year fix.
And dual income.
Dual income. Yeah. Dual income as well, because now you're able to use 2 incomes to solidify and be just, locked in for 30 years. But then 30 years doesn't mean you keep the same rate. You lock in the purchase price, and that doesn't go up or down. Your rate could go down. shouldn't go up unless
Yeah,
right on top.
Yeah. And there should be a rare occasion that you have to refinance your loan in an up environment.
Yeah.
But the goal is that in a lower down environment later on, you could get a reduced interest rate because you've already been holding possession. So.
And truthfully, first time home buyers. If you're a first time home buyer, you should definitely get a 30-year fix. Start off, get an idea of what it is to purchase a house, understand what it is to make your payments. Unless, like I said, you're savvy, you understand how leverage works, and you understand that it's not a forever loan and you're going to be in there, then go with the ARM. But
okay,
30-year fix is safe.
Next thing is, we've been kind of offline and on camera a couple times talking about should people buy or should they wait. I want to talk about what situations exist in someone's life that they should wait, what situations are existing in someone's life that they should buy. So wait versus buy is our last segment today. So Brian, let's talk about why someone should wait to buy a house. 2026, it's just not the year. Here are the things happening in your life that this is the year you have to wait.
So I would say that it all starts with job security. If your company's been experiencing layoffs, if you're unsure about, whether you're going to have the same job or job security, maybe you shouldn't rush into having a big debt and a big commitment. I'd start off there. If you just got a pay increase, if you have, ample amounts of savings, you're in a position where, your rental payment, you can make it comfortably, but, you're just kind of, making it because it's comfortable. I think those are the people that should start looking at, purchasing a house, because then down the line, as rates come down, just speaking here in San Diego historically, as rates come down, we're already on a housing shortage. More people will enter the market. Houses will become more expensive. We go back to what San Diego market is, which is, pretty chaotic, multiple offers. So if you're able to get in, sooner rather than later, you're going to emit a lot of competition. And I think that's the big factor right now, that if you're keen on getting the best rate right now, rates are on the way down, and rates go down, prices go up. So you really are trying to time the market, but it won't work out in the way that you want it. If you can afford it now and you could pay for it right now, take the move, do it, because later on, when there's multiple people out in the market and rates are a lot lower, that house will go up in value. There will be a lot more competition, and now you're going to be going multiple places trying to secure a house when you had more leverage in the beginning, right now.
So my advocacy for waiting to buy a house this year revolves around the topic of uncertainty.
Yeah.
Known uncertainty, not perceived uncertainty of, maybe someday, possibly could, maybe, perhaps. No. Not all the stuff we make up and we walk around our head like, sky's falling. Maybe. No. Known uncertainty in your life equals wait, just wait. And my second item here is, if you're shoehorning yourself into a deal, just wait. Yeah. Optimize the situation, make it better for yourself financially, whether it's your credit and your credit score increasing gets you a reduced rate, which then makes you have a lower payment, or paying off debt, which increases your purchase power and reduces your debt load on your monthly budget. Or, so these kinds of things, the very practical, tangible things, those are my wait items. If you have all these items Brian and I are talking about today locked up, you have choices. If you are tight on your credit score, you got down payment, whether it's 3.5%, or you're VA qualified, that might be the year. And then if you have the ability to fit into a 30-year fix and you have the choice of an ARM or a 30-year fix, then you have a tactical decision to make. So I think those are some of the causes, very tangible, very black and white. I know, very mechanical today from Uncle Andy in the corner. But it's for that reason, is there are trace elements of success in the market right now. And I'm gonna say what Sam Cramian said here months and months and months ago. Success leaves clues. Yeah. We're seeing clues all over the place of what's working to get buyers into home, what people are refinancing for, and that's why I wanted to talk about this very elementary level today, because look, success is leaving clues all over. People are getting into escrow. Sellers are selling places. There are deals on the table. There's negotiations happening. There's concessions going on. There's price reductions in some neighborhoods. The market has come down from where it was in the last 12, 24 months. There's a lot of things aligning that this could be the year for you to buy a house. That's all I got. I'm not going to say anymore. That's my compelling pitch. Now, there you go.
And I'll give an example. My sister, we just got her pre-approved yesterday, and she started to look, and we got her approved. And she's like, "Well," I asked her, "Have you looked for anything?" She's like, "No, I haven't." The amount that they got approved for is pretty significant, but not the amount that they want. That's besides the point. But what I told her is, just because mentally It's not the amount that you're looking for. Have you looked at houses? No. Go look at houses and tell me what you see. I looked at houses for her. I sent her a list. She's like, wow, that was fast. I'm like, see?
So she thought there were no options because she thought, oh, well, this means I can't have the thing I want. Yes. And you're like, here's a bunch of things you said you want.
And sometimes it stems because of what other people have that makes you feel like you can't attain that. But your situation is a lot different than everybody's situation. So my lesson in this is, take the action, go run your numbers. You're not committed to anything if you don't like the approval, but it will give you clarity. And I think clarity right now is the name of the game. Clarity, understanding, and preparing. Because if you have those three things, it's just a matter of time for things to fall in place.
I love that. That's an acronym in there. CUP, clarity, understanding, and preparing. I love it. You just made a new acronym on the show.
Get out there and CUP.
The trick is going to be remembering it.
Yeah.
We're going to write. Someone write that down. Someone write down CUP.
Hey, can we get notes, please?
Yeah.
Can we get a note of that? Timestamp?
Brian, thank you so much for a great show today. I have not asked this question in a long time. What was your favorite part of today's show?
My favorite part of today's show was honestly just having that straightforward back and forth. Sometimes it just needs to be like that. You don't have to put all this fluff in it. You don't have to, try to make it sound perfect. It just needs to sound how it needs to be understood. And sometimes it's just being straight up, honest, firm, and hey, that's it. We're not trying to say more, try to say less, just straight up what it is.
The favorite part of the show for me today is the word shoehorn. I've decided 2026 I'm going to add the word shoehorn into my vocabulary a lot more. It's so descriptive, and I love it, and I think everyone understands what that means. Also, I will admit, I think the word shoehorn also kind of reveals how old I am too. So if you don't know what a shoehorn is and you're like a young person, look it up on the internet, and then you can yell at me in the comments as the old guy.
It's that game you throw, right?
Okay, we got to go. Brian, great show today. Y'all, thank you so much for tuning in. Remember to subscribe, all the stuff you're never supposed to say at the end of a podcast, but we say it anyways. Do all that stuff. We love you guys. We'll see you next week with another great show. Bye.
If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.